The allure of a financial instrument that pays you indefinitely is undeniable. While the promise of eternal income might sound too good to be true, perpetual bonds, also known as consols, offer precisely that, a stream of regular interest payments without a defined maturity date. Understanding the mechanics, benefits, and risks of these unique investments is crucial before considering them as part of your portfolio. Perpetual bonds are essentially debt instruments issued by corporations or governments that don't have a maturity date. Unlike traditional bonds, which mature after a set period, returning the principal to the investor, perpetual bonds continue paying interest indefinitely. This interest, usually paid semi-annually or annually, is a fixed or floating rate depending on the terms of the bond issuance. The issuer is obligated to make these payments unless the bond is called, a scenario we'll examine shortly. The appeal of perpetual bonds is multifaceted. First and foremost, they offer the potential for a steady, predictable income stream. In a world of fluctuating market returns, the consistent interest payments can provide a comforting sense of security, particularly for those seeking stable retirement income or a reliable source of passive income. This predictability can be a powerful tool in long-term financial planning, allowing you to budget with greater confidence. Secondly, perpetual bonds can offer potentially higher yields compared to traditional bonds with comparable credit ratings. This is because the added risk associated with their indefinite maturity date, the lack of a principal return date, often incentivizes issuers to offer higher interest rates to attract investors. This higher yield can be attractive to those seeking to maximize their returns, particularly in a low-interest rate environment. However, the forever aspect of perpetual bonds also introduces unique risks that you must carefully consider. The most significant risk is the lack of a guaranteed principal repayment. While you receive continuous interest payments, you don't have a predetermined date to recoup your initial investment. This makes them unsuitable for short-term investment goals or those with a near-term need for liquidity. Furthermore, the issuer's creditworthiness is paramount. Should the issuer default, your stream of income ceases, and the value of your investment could plummet. Therefore, thorough due diligence on the credit rating and financial health of the issuer is essential. Investing in perpetual bonds issued by financially stable entities with strong credit ratings mitigates this risk, but doesn't eliminate it entirely. Another critical risk factor to consider is interest rate fluctuations. While some perpetual bonds offer fixed interest rates, many have variable or floating rates pegged to benchmark rates like LIBOR or other indices. If interest rates rise, the relatively fixed return of your investment could become less attractive compared to newer bonds offering higher yields. This can negatively impact the market value of your perpetual bonds, even if the interest payments continue.